Hello and welcome to Cafe Mutual YouTube channel. Friends, passive funds have been gaining traction among investors. In fact, passive funds now contribute almost 17% of the total industry AUM. Talking about the individual contribution, it has also grown to almost 20% of the total passive AUM. To talk about more about passive funds, today we have invited Pradeep Pandey, Head Sales ETF, Nippon India Mutual Fund. Pradeep has over 18 years of experience in financial services industry. So let me invite Pradeep to the show. Good morning, Pradeep, and welcome to the show.
Thank you, Nishant. Thanks for inviting me and having me on this talk.
So Pradeep, since you are expert on passive funds, so I wanted to know that how was 2025 for passive investing, and what could 2026 look like for passive funds?
Yeah, Nishant, it's a very apt question to start with, especially in December. Sitting in December, you can reflect upon what has happened in the entire year. So this has been an inflection point for passives globally,
Hmm.
where in fact one of the largest market, that is US, which accounts for more than 65% of global assets, the 50% of mutual fund AUM has have shifted passive.
Hmm.
And that tells you a story that people globally, not only in India, are looking passives more strongly than ever before.
Hmm.
If I have to put in a number for the global asset under management, which is being managed passive, it's close to 43%. So that is the broad direction in which the industry is moving. And if we have to particularly talk of India, 2025 was litmus test for our markets also. So equity markets were consolidating. You had fixed income market where post taxation change, there is hardly any inflows into passive debt funds. So it was a litmus test of a sort, but markets didn't disappoint or the industry didn't disappoint. As we speak, we manage on passive side close to 13.5 lakh crore, which you rightly said is close to 17% in terms of market share. But
Hmm.
the story doesn't lie there. The real story lies when we look at the volumes on ETF.
Hmm.
So volumes on ETF till September, which is the published number, is close to 3.29 lakh crore. And that is 90% of what happened the entire last year. Now,
Hmm.
that's a very strong direction in which the adoption of passives is moving.
Hmm.
Net flows of passives is close to 1 lakh crore. Now, again, 1 lakh crore in a year where markets were consolidating, equity markets were in a way sideways and was not providing a direction is a very good number to have. So if we see that uh, the broader direction is that people are looking at passives more strongly. It is people are making passives as part of their portfolios. And if I have to look at funds where the inflows are coming, and that is very directional in nature, Nishant. I feel that 80% of the flows which come, they are coming into Nifty indices, Sensex indices, and commodity ETFs. So Nifty and Sensex indices become part of the large cap allocation of clients, and the commodity ETFs is clearly visible that people are now looking at commodity not only as inflation hedge but also as financial allocation. So that is telling us story that India is moving away from holding physical gold and silver to holding gold and silver in ETF form. Maybe I'll stop here, and if you want to ask a follow-up question on it.
Yeah, yeah, yeah. So, Pradeep, despite market volatility, passive funds continue to gain traction among investors. So, what are the key reasons for this trend?
Yeah, this is a very important question, and volatility is one topic which is very close to me because uh, if there is no fear of volatility or there is no fear of drawdown, most of the people would like to invest in risk assets. And because we all know that over a period of long term, risk assets would generate you more return than any other alternatives on fixed income side, or maybe alternatives in deposit, bank deposit, or maybe safer options.
Hmm.
So when I think of 2025, I would always think of this as a year which was full with contrasting news flows. So you had on one side war going on in three continents, and then peace talks going on simultaneously. We had Trump trade and tariff. You had AI euphoria on one day, then people were talking of AI bubble. People were like on one day taking one side of market position, and suddenly the news flow used to turn over the tweet. So that way it was a very interesting year. In India also we saw great GDP prints, right? But those great GDP prints were not translating into corporate earning growth, and that is why markets became volatile. And we have to recognize a fact: when markets become volatile, your valuation can compress or expand, your sector might rotate, your stock leadership might change, and that can cause sudden drawdowns. And that is, and drawdown is one factor which investors fear the most.
Mm.
And it's natural, but natural to feel uncertain and having butterflies in your stomach. And as an equity investor, if there is a 15-20% drawdown in my portfolio, then I always think that why did I invest in equities? Why not any other alternative fixed income or fixed deposit options? But yes, that is where your passives come into picture. Whatever we say, whether we talk of volatility or we talk of uncertainty, basic truth of investing or basic tenets of investing don't change, which we have like seen over a period of time, and that is transparency, simplicity, cost efficiency, and time in the market rather than timing the market. So, and that is what passives provide you with conviction. And I always feel, Nishant, that mantra is to invest in a diversified portfolio at a low cost for a long period of time and let compounding take care of it. And it's for no reason that compounding is called eighth wonder of the world, right?
Right, right. Interesting response to the question, Pradeep. So I'll ask my next question. So passives are often considered less attractive by MFDs, as clients may not see value, as by design they are not meant to outperform the benchmark. So what is your view on this perception of MFDs?
I think that is changing at margin, Nishant. So you are right when you say that by design they are not meant to outperform,
Mm.
and that is a design, and that's a initial discretion which any client or distributor have before they come into passives. So as we speak, you look at the number of options which you have in passives. So
Mm.
there are more than 350 index funds, there are more than 300 ETFs, and put together there would be almost 135 indices which these index funds and ETFs track.
Mm.
That is huge, right?
Mm.
And the amount of choices which today investor or distributor have for passive is humongous. So, and value to my mind is a very broad term. Value is not only about outperformance in a particular year or in a particular time frame. So value, in fact, advisor can add value through multiple things, and those multiple things can be things like asset allocation, risk management, behavioral coaching. These are more important aspects of investing rather than outperformance or underperformance in one particular year. And if you look at markets over a period of time have done very well. In fact, you look at any time frame above 3 years, 5 years, 10 years, 15 years, 20 years, 25 years, markets have done well.
Mm.
But how many of the investors have been able to capture this performance into their portfolio returns? And that gap I feel is the behavioral gap.
Mm.
So distributors can help clients, in fact, narrow this gap. And that is where the role of passives come in. Passives by design, as you said, they are not meant to outperform. They are meant so that you can stay in the market for longer period of times. And
Mm.
as I said, if you stay in the market for longer period of time and survive, you will definitely thrive. So that's my small take on this. And also, if you minimize chasing returns and market timing, I think you also avoid emotional exits, and those emotional exits are the cause of your underperformance in your portfolio. So combining passives as your core and active as satellite exposure, I think is the way to go forward, because alpha would always be transient in nature. Today, I one of the say one good fund manager might have that alpha. Tomorrow, somebody else would have it. So it is transient in nature. No one fund manager would outperform in all cycles. So that's why it's important that you divide your portfolio as core and satellite and have exposure to multiple kind of strategies.
Mm. Very insightful response, Pradeep. But this also brings me to the second most concern of the MFDs, which is low commission. So generally, index funds are low cost, and hence it is meant lower commission. How does it make economic sense for them then?
Yeah, this is very interesting topic. And in fact, despite of low commission, it's not that our partners have not adopted passives. So
Mm,
last 5 years, especially at the start of COVID, if I keep that as inflection point, there has been huge adoption of passives by our partners. So only speaking of these 5 years, why COVID is important? Because that coincided with your uh, uh, explosion of financial inclusion in India. So that's why COVID is an inflection point for me. So last 5 years, if I have to take the AUM from in index fund from our partners have gone up 16x, and that is huge growth, right? SIPs from our advisors have gone up 17x, whereas their folio counts have gone up 10x. That
yeah,
is much higher than the active side.
mm,
So when I started my career 20 years back, I used to go to insurance advisors to impanel them for mutual fund distribution. And there was huge pushback from them because the margins in insurance business was maybe uh, 5x, 10x higher than mutual fund. Mutual fund at that time, it was also relatively an expensive product if we compare it from now.
mm,
But the margins in insurance were huge.
mm,
But there were many adopters of MF mutual fund distribution at that point in time, and I'm in contact with some of them. So, and if they compare today, so their mutual fund distribution is a bigger business than their insurance business. Some of them, in fact, have stopped that business and only focusing on mutual fund distribution as the core of their business. So over a period of time, if the product quality is tilted towards
mm,
in favor of your investors, the product line is definitely bound to do well, and that is the advantage of achieving scale, right? So I as a business professional would always choose scale over margin,
mm,
and we have seen like whenever the regulator has come in and reduced expenses, the response of investors have been bestowed by investing more. And and if at all, again, this is a very apt time because yesterday only there was some reduction in expenses by regulator. So
mm,
so it's a very in a way positive thing that distributors
mm,
can look at and maybe build business around it. So our many partners are building their business on passive only model, and they are doing very well and growing very fast. Plus
mm,
other qualitative aspects which I have to put on the table, some of them can be that it also helps you say attain some client trust, right? If you are advising him low cost product, advising him products which are fiduciary where you are keeping fiduciary responsibility at your mind, so that way client also stays for longer. And long-term commitment by client also leads to stable AUM and also higher recurring revenues. So I think that is the direction where I would like to think. And also, you look at there is a competition from advisor-only businesses also, where people are building their businesses purely on advisory and fee-based income. And if you don't say offer your clients a low cost product, somebody else is going to offer them. And if I have to look at the broad say market division or market share of these direct oblique RI digital businesses in index funds, that's very high. I think if partners don't adopt, there is definitely a competition for it. And our partners have always been very flexible, ready to learn, ready to adapt. And I'm sure like there is no way that they'll miss on this big trend of big opportunity here.
mm. Nice, nice. So Pradeep, passive funds have overtaken active funds in US in terms of AUM. So what is your outlook for the future of passive investing in India?
I'm very excited about the future of passive investing in India. So, if I have to look at my capital market infrastructure itself, so there are 13 crore plus unique Demat account holders, whereas
Mm,
unique mutual fund investors are only 5 crore. And if
mm,
I talk of only ETF investors, they are about say 2 crore 6 lakhs kind of number.
mm,
So, if I only utilize my capital market infrastructure, my growth can be 6x in terms of number of investors. And the experience of buying a ETF is very similar to experience of buying a stock. So
Mm.
these investors would definitely going forward would be exploring ETF as an opportunity. Uh, so, uh, so we are very excited as a fund house also about this. And you mentioned at the start that US markets have gone more than 50% passive, and they've always in a way shown us uh, what's going to happen in the future. So I think there would be a broad adoption of passives. Maybe close to 2008 was a time when US was at the stage at what we are today, maybe another 15, 17 years. And whereas this can happen much faster because India has always adopted things faster than any other market. And we have seen what has happened to digital with Jan Dhan, Aadhaar, and mobile stack. The adoption of any technology or any innovation is very fast in India. And that is the direction which we feel passives can also go.
Great, great, great. So, Pradeep, my last question. So, there is a wide range of passive fund available, of options available today. So, how can distributors shortlist the most suitable funds for their clients?
Yeah, that's the most important part because whatever said and done, this is a question which can decide the execution part of passives. So any execution or any allocation should start with qualitative aspects of investing. As I mentioned, like that is more important than the quantitative aspects of investing. So first of all, there should be a clear-cut goal, risk tolerance, time horizon. So that should be a broad framework before you decide on asset allocation. And once that framework is ready, then today there are there are so many say investment options which are available with a distributor and investors which he can look at. So you look at equity. If I have to look at different say asset allocation components in equities, you can have market cap based indices. In market cap based indices, you can carve out a certain market cap if you want. If you want to go pure large cap, you have Nifty 50, you have Sensex 30. If you want to say maybe go the lower end of the large caps, you have Nifty next 50, you have Sensex next 30. So that way you can carve out a certain aspect of market cap. And if you want to go a particular, if you like a sector, say suppose you like IT today or you like banking today, so you can go to a sectoral ETF or index funds. Then there are thematics. If you feel that in a growing economy like India, infrastructure can do well or real estate can do well, you can go into thematics. And obviously there are factor-based indices also. And that's a very say at although in India it's at very nascent stage, but offers a lot of promise. So based on your liking about a particular style of managing money, whether it is momentum, value, alpha, quality, low momentum, low volatility. So there are multiple options which are there with the investor to allocate. And it's not only in equities that you have options. Today you have options in debt also. So in debt funds, you can like start from the say something like liquid ETFs. So if you have money and you're not decided that which ETF you are going to buy, you can park your money into say liquid ETF, and also maybe you have certain time horizon in mind, say 6 months, 1 year, 3 year, 5 year. You can coincide that time horizon with the kind of target maturity fund you want to have,
Mm.
and the credit quality of these target maturity funds is very high. So that way you can look to design your or ladder your goals based on your risk profiling, your asset allocation. Then obviously you can take duration exposure. If you feel that yields are going to come down and you want to take certain duration exposure, there are options for that. And the most trending aspect of ETF, which is commodity, whether it is gold or silver, offers you options on both ETF side as well as index fund FOF side. So you have multiple options today. It's just that you have to choose your qualitative part before deciding which fund, which style you want to invest, and then you can allocate accordingly. And the most important part, we all have to realize as investor or distributor that it's consistency which beats chasing short-term performances or short-term alpha. So you have to focus on long-term. Return in equities can be volatile. You have to remain ride the entire volatility, and returns can be back ended, but the power of compounding only comes into play when you are invested for a longer period of times. And I would just like to say, end it with what Warren Buffett has achieved in his investing. So 99% of his wealth came when he turned post 50. So that is what longevity can do to your wealth. So yeah, that is where I would like to stop.
All right, so we have come to an end to this interesting discussion. Thank you so much, Pradeep, for your valuable time and input. You have been, I mean, you answered all the questions very vividly, and you have given a lot of insights to our audience.
Thank you so much, Nishant.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Thank you.